are recording. Hi, Scott. How are you?
Great. How are you?
Well, it's been a hot minute since I have been doing a podcast, and I miss it. I really do. I miss it.
Since you've been podcasting?
I know. It has. And I've missed you. It's been a long time since we've sat here at Interest Mortgage and
Brought the wisdom?
Yeah, and talk about some real estate. You know,
exciting stuff.
I know. A lot of people will be like, "Brr," but we try to make it exciting.
I can literally hear them changing the station right now.
Yeah, maybe. I don't know. I think they kind of, you know, I was looking at my stats, and even though I haven't recorded in a while, people are listening to it, and I thank you. Thank you guys for listening. I did curl my hair today. I mean, do you know how long it's been? Almost as long as I've done my podcast.
This is the exciting content that people tune in for.
They do.
When's the last time Claudine curled her hair?
I know. I'm probably 2023.
And thanks for listening.
But all right, let's get back on topic.
Okay.
Just a tad. So we're gonna talk about. I've had some clients, some buyer clients, contact me about this 50-year mortgage, as well as this transferable or portable, whatever the hell. Have they even named it yet?
The word I've heard used the most is portable mortgage, but
I think of a porta potty, Scott, when I hear that.
The logistics behind it will belong in one, but we can get into like what they are, the thought process behind it, and then we're not here to tell you if it's good or bad, but we can give you the counterpoint, I guess, and let you make up your mind. Did we not learn a lesson in 2008? Yeah. Do you really think that this is the way for affordable housing is a 50-year loan? I mean, I guess to start there is the two ideas being brought up, I guess, how serious they are and how far they're going to go, who knows, but is... Yeah, the 50-year mortgage, right? That's probably the most common one we've heard is. Right. And logic there is when you have a longer term, the payment's cheaper. Is it that much? It's to give people an idea on like a $300,000 loan, if you take an average number, going from a 30-year to a 50-year is about $200. So
some people that's a lot of money. So that's groceries for some people.
Sure, and there'll be, I'm sure there's stats out there everywhere else that's that'll let this many more people qualify or this. Maybe. Okay. Right. And then we can go into later on is it really worth it? Is it good? Is it bad? Is it a good idea, bad idea? Who knows, right? So that's the one is it's going to make it's a longer loan, so it's a cheaper payment, and they help people qualify. The other one, the porta potty, the
porta potty,
mortgage, in simple terms, and again, there's this one, in my opinion, there's a lot more moving parts to it, so who knows if it'll ever happen, because there's so many things behind the scenes that we can get into that. Don't know how realistic it is, but in theory, take all the people that took out loans during COVID or whatever it is, and they're bringing this up now because
2.5%.
Yeah, they're bringing it up now simply because rates are higher now than they used to be. Okay, so it's like,
but it's gone back to where
it's kind of terrible. People got spoiled because rates were in the twos, right?
Well, they wanted to generate the economy. They wanted to generate the real estate industry, and what better way than buying real estate, right?
Yeah. So the logic behind it is, it's hey, I have a $300,000 loan I took out years ago at 3%. Why can't I just take that loan and put it towards this next house and keep my 3% loan? It's kind of like a credit card. Why can't I spend my money wherever, right?
Right.
But we get into it. It's in theory. Sounds simple enough, right? You already got the loan, just move it over here. But it's not that simple.
Well, it's not. Let's talk about the 50-year first, and then we'll get into what I'm calling the porta potty, movement mortgage, whatever you want to call it. Okay. 50-year loan. You're indicating $300,000 house, might be able to save $200 a month. But how many years is it going to take before you start getting some equity out of this?
A lot, yeah. That's the joke you see people online like, people that take out a loan, this is their first house. They're like, you'll be in debt till you're 80. You'll be in debt till you're 90.
Right.
And I get that. Is stretching a loan out from 30 years to 50 years to save $200? Is that
a good idea. Some people say yes because now they can buy a house they couldn't qualify for. Other people look at it, if you look at it, how much interest are you paying and everything else.
Exactly.
Yeah, it's a lot more.
Yeah, $300,000 house could turn into freaking $900,000 after
easy.
with the interest.
Probably more than that, yeah. And the arguments I see all the time are people like, obviously, even on a 30-year loan, the first couple of years you're paying mostly interest.
Right.
You don't pay it much down. So 50 years is even worse.
And who was the president who established the 30-year? Was that right? Who was that?
God, you put me on the spot.
I know. Shit. I should know this. Anyways,
make up a
Roosevelt?
Name. I think it was.
Was
actually.
it Roosevelt? Guys, don't hate us. We always go on a fly here.
Yeah. So the stuff I see, the proponents for it are saying, hey, it's a cheaper mortgage. And to go back, most people, especially the first time they buy a house, they're always thinking like year 30. Very, very, very few people keep a loan 30 years. I think the average is around 6-7 years. It's either people move, a life event happens, what's divorce, something happens, or you refinance, that you don't have that loan there. The average life might be 6-7 years to have a loan. See what I did there? 6-7 years. Mm-hmm. We're here all week. But is if the housing people are like, well, if you're going to move anyway in 5, 6, 7, 8 years, whatever it is, you're not paying a 30-year down that far. You're not really.
Yeah.
So for 50 years, it's paid down a little less, but you're still not really paying any equity. They're just banking on, the house will keep going up. You'll sell it, you make money.
Right.
It got you in the real estate game.
Right.
You built some equity, not because you paid it down. You built the equity because the house is going up.
House pricing, yes, which has been going up.
And if that keeps happening, you could take out a 100-year loan. Let's say you didn't pay any principal ever.
Right.
And you basically rented the house, but you owned it. You're not paying any equity.
Right.
As long as the house is kept appreciating, that would be worth it to you too.
But it's the one thing that I worry about, and I have clients that they're like, oh, Claudine, my house appraised for blah, blah, blah. Mm-hmm. And I'm like, that's great, but appraisal value is different than market value.
Correct.
Because market value, folks, is what people are willing to pay for that property. So if you're going to sell it,
which could be higher or lower,
it could,
depending on what you're...
Exactly. You could have an appraisal of a $500,000 house and it appraised at $535,000, but guess what? You're selling it at $490,000 because that's what the market value is saying.
The negatives of that 50-year are going to be any slowdown of appreciation, or God forbid depreciation, house going down.
Don't say that.
And you can't. You're going to be in a worse position trying to sell your house after X number of years. If you try to sell a house right away on a 30-year loan, you better hope it appreciated, right?
Right.
If you're going to make any money, 50 years is going to be even worse because it's that much less you're paying.
Right.
But the young couple, let's say that because of numbers and how we do loans and qualifying ratios, because they can't get approved now, and maybe they could if we did have a 50-year amortization, they're going to think it's the greatest thing in the world. Now, is it the right decision? Yeah, maybe not. Who knows? So there's people that think it's a bad idea. There's people that think it's a good idea, and I see the logic on both sides.
Right.
But like we were joking earlier, why 50? Why do we 60
why stop
years?
at 50?
70, right?
Right.
I mean, but logistically, it could happen. There's just a little bit of there's what's called every loan has to be what's called a qualified mortgage for the big most of the market anyway, and that can only be a 30-year term. So it's simple legislation they'd have to pass and say, well, this can now allow a 40-year term or a 50-year term or whatever it is.
Okay.
But other than that, it'd be a pretty simple thing to implement.
I mean, it's you're.
Claudine's not a fan of the 50-year mortgage, and I'm not saying I am.
I'm not because it's. I think it's almost like a false pretense for a lot of people, and I get wanting affordable housing and so forth. I get that. I really do, because I have clients right now that their budget is below $200,000, and it's very hard to find them a house that can qualify for FHA loans underneath that amount. But I mean, how then when you're doing a 50-year, I
think what it is again, I'm not on the side of I think it's a good idea. I see the logic behind it. But you go back, it's the same logic as take cars, for example. what used to be the longest, 48 months used to be a long car loan?
Right. Now it can be 6 years, 72.
I see 8, 9. I've seen 10-year.
Jeez.
Like people taking out, it's nothing to see a 72 or 84-month car loan, 90 months. We see them. So if and the reason they did that was why? Make the payments lower, right?
Lower, yeah.
Okay.
Well, what do you want to make your payments, Claudine? I would like to keep it under, $600.
Yeah. So they go, okay. 97-month car loan.
Exactly. And then you're like, I'm going to be freaking 62 before I pay off this damn car. Yeah. And at that point, with a car, depreciation is right when you take it off the lot. Unlike a house, but I get what you're saying, that in order to be able to afford...
The housing will affect the overall economy more than like a car crisis.
Correct.
It could,
right.
But yeah, it's the same logic though. You didn't hear anything when car loans started to go to 5, 6, 7 years. They just happened.
Right. Yeah.
For the sole reason it was, I can't afford that $60,000 car over 36 months.
Yeah.
Right?
Well, especially during COVID, it was... that you couldn't get a new car because some chips couldn't be made and stuff was sitting, and so guess what happened? Used cars.
Oh yeah.
That the prices of used cars went up, and I was a culprit of that due to a car accident, and I had choices. Don't get me wrong, but I needed a car that fit my lifestyle and my job.
And what lifestyle is that, Claudia?
Well, I'm high maintenance. I'm not gonna lie.
It needs room for shopping bags.
Well, that and at the time I had 2 dogs, but to fit a for sale sign in, I needed
fall back on that. You needed the real estate sign. You needed room for the real estate sign.
Well, I needed also the poundage so I could write it all. I know. I'm not gonna lie. I'm going to use the tax system to my advantage as much as I can, but I fell into I had to get a used car that fit my budget of what I was wanting, and the interest rate compared to what my other car was, I was floored. And I'm sitting there and I'm thinking to myself, I'm like, I almost have it paid off now, but I'm sitting there going, I'm going to be almost freaking 60 before I pay this damn car off. But it's going to be before then because I'm trying to pay it off sooner. But it's to me, it's almost that same concept. You're
stretching it out. You're just if you have to stretch it out that far, can you afford it? That's
right.
So, like I said, there's gonna be people. You'll see them on different shows and other podcasts and everything else. There'll be people screaming from the rooftops that's the greatest thing in the world, and there'll be people screaming it's the dumbest thing in the world.
Right.
And they're both right.
Oh,
so
true.
True.
Everybody has an opinion.
Exactly.
Yeah.
So that's the 50-year. The portable one.
How would that? Real quick. How as a lender, how would that affect you? Would it affect you as far as you're getting your cut of the deal?
I don't think. I mean, the 50-year doing the loan.
Like the longer the loan.
No. I don't think anything really changes. Honestly, with
would it be decreasing though, or would it just stay the same?
I don't think it changes much of anything, to be honest with you, in the whole lending side of the world. Yeah,
okay.
It literally is. It's instead of 360 months, it's 60 months or 600 months for qualifying. Sounds like a long time, doesn't it? 600 months. It'd just be simple math of this is now amortized over 600 months.
I'd be almost 104 before I paid a 50-year loan. Jeez,
no age discrimination.
So. No, but I just. No, it's a long ass time.
From a logistics standpoint of implementing it, I think they could do it very, very quickly.
Okay.
It's simply changing the number of years the loan's calculated over, and you qualify off of that now.
Well, and everybody thought the 30-year loan, was kind of crazy too when that took place. But it's
commonplace.
It's the norm now. But I guess we'll have to wait and see.
Yep.
Now the porta potty loan.
Porta potty mortgage. Yeah,
that's going to affect my industry. I'll tell you that right off the bat. It will affect my industry because if you, I think it will.
I'll tell so people know what it is that they're even referring to, because there's a lot of misinformation about that. Okay. Is in a perfect world, people think, hey, you would only consider doing this when you have a lower rate on your current mortgage now. Than what they are that you can go get on a new one. Okay.
Right.
So the logic is, hey, I bought my house 5 years ago. The bank lent me $300,000 at 2%. right? So I owe $300,000 at 2%. I want to move. I don't want to go borrow all this money at 5, 6, 7%. Where, I already got $300,000 lent to me. I'm going to take this with me. Put this $300,000 towards this new house, and whether I pay cash for the difference, there's always things going about logistics of it. Do I go get another loan if I need more money because I need $500,000, but I only have $300 for my other loan, so I still need to borrow another $200.
Right.
Do I go get it? Now that would have to be a second mortgage product because this is a first mortgage product that I'm taking with me. That's all that logistics, which is really hard to figure out.
Well, that and also the second mortgage, your interest rate are going to be higher.
There's a million different things that go into it. And when you priced out that first mortgage, when you got the loan 5 years ago, there's different pricing for a regular single-family home versus a condominium versus a manufactured home versus how much you put down. So the logistics of just transferring this loan somewhere else, like it's a credit card, is a logistical nightmare. I don't know if it'll ever work itself out.
I don't see the logic in it due to the fact that I've had sellers that are like, Claudine, I want to downsize, but it's really hard to do so because I right now when I refi, I have a 3.5%.
Yeah.
3.5%. But what I try to explain to them, it's kind of a net. Because the pricing of the house has gone up for when you bought it.
Right.
We're going to sell it for more. You're going to have more
then you put more
equity.
To put down. Yeah.
Yeah.
But
so I just don't.
But in that scenario, what they're thinking of, let's say you're thinking, right, you made $200,000 on this house. We're gonna sell it. That gives you $200,000 to put down on this next house, right?
And they're gonna well, it's gonna cost more because now it's interest rate.
I was at 3.5, now I'm gonna be at 6. So what the people are thinking, the simple and the politicians up there explaining this is, the bank already gave you money at 3%. Just take it with you. Kind of like a credit card. They already gave you a really big Visa card. You can spend it wherever you want, right? Any store, just go spend it.
I don't see it. I don't.
There's so many things.
Plus, if you're doing a second mortgage, the first mortgage, correct me if I'm wrong, they're getting their money first before the second mortgage does.
In the case of a foreclosure,
yeah. And if you default.
Well, that's why the rates are, everything's priced in with risk. So, if you're first in line, those are going to be the best terms. If you're second in line, that's why the rates are higher. That's why there's harder qualifying because they're a junior lien. The other part that people they haven't even addressed this. They bring it up and then let's not talk about it. They just talk about transferring the interest rate, right?
Yeah.
But then people are like, well, they have to get reapproved. Well, maybe not. When you take out a mortgage and you have, let's say, good credit, you have your good salary job and whatever, and 3 years go by, the bank's not calling you up saying, hey, send me a new pay stub, make sure everything's still good. You have your loan.
As long as you're making the payments.
As long as you're making the payments,
right?
That loan's there.
Right.
They gave you a loan for 30 years. Maybe down the road it'll be 50, but for now it's 30, right? So you got that loan. As long as you're making your payments, you can quit your job, go start a new business, go do this, and nothing changes with your loan.
Right.
So what, I don't call them politicians, the housing people, they're bringing up like, oh yeah, just transfer this loan to this new house.
Isn't it? I mean.
Yeah. So you have not only all the pricing parameters, the down payment, the loan to value ratio, and what's the property type, and all these things that go into pricing a loan that gets transferred now that it's not the same risk pool.
Right.
You have to get reapproved? Do you have to show that you have a good credit score still or anything? Who knows?
Well, if you have a second, wouldn't you have to?
You would have to for that, yeah.
And then if you don't get approved for that second,
then you can't transfer the first one.
Exactly.
Yeah. So there's a lot of stuff that comes up.
It's
and then, but people bring up
don't understand.
they only want to do this to transfer their lower interest rate loan instead of taking out a new one, right?
Yeah.
So if all the course people that are pushing this are like, no, you don't have to get reapproved. You already got approved 5 years ago. Transfer that loan. Well, then that opens up. Why is that going to work all the time? Can you always just transfer your mortgage? What if you did change your job recently, do whatever, and it's just not gonna. I don't
see it fine. Well, no. And it's like, transfer your credit card balance to this other card that no interest whatsoever for 2 years. Well, yeah, that sounds fine and dandy, but if you don't pay off everything after you transfer that,
then you get whacked.
Then you get whacked with 32% or what? Yeah. I mean, I'm being astronomical here, but
there's some that are. There's so many. Being in the business, it would be such a logistical nightmare, and we understand all the moving parts that go into it.
But our clients do not.
They don't, and I don't know how with the different risk pools and how things are securitized, how they even think in a chance in hell that they're going to somehow pull off this portable mortgage type product. I could be wrong, but the 50-year one, I don't think, aside from the philosophical beliefs of it, it's not hard to implement.
I get that, but I mean, I really, really wish that there would. I mean, I don't know. I'm a visual person, and I would like to see it in a spreadsheet. And I would like to see.
There's not enough Excel. There's not enough columns on a spreadsheet for all the different variables that could go into this situation. Because again, go back. I didn't really explain it right the first time.
Oh
Take the guy that had 800 credit score, had a salary job for 20 years, put 20% down, bought his house, and has a 3% mortgage, right?
Yeah.
And his credit could go to crap and everything else, and it doesn't matter because he still has his mortgage, right?
Right.
So he's allowed to keep that mortgage because he already got it. He got his house, living his life. If we bring up this portable thing, now would he be allowed? Let's say rates don't go up.
Mm-hmm.
Because if rates were lower or better, then people wouldn't want to transfer the loan. They'd just go get a new, cheaper one, right?
Right.
But let's say you're in the situation where your credit went to shit. Your employment status isn't any good.
Yeah, or you're self-employed and you can't show that you've...
Or you got laid off, or whatever happened.
Right.
You can't get approved for a mortgage, but you want to sell your house. Even if rates are lower, if I have a 3% loan and rates are at 2%, but I can't get that 2%, so it doesn't matter to me.
Then you want to transfer.
I want to move. I want to transfer my 3% loan I already have.
Right.
Because I can't get approved for a new one.
Right.
Is that going to be allowed? Or would you have to show that it's, you know what I mean? Because
that's a good question.
You talk about a huge risk pool. No one would lend that person money. But if some people are allowed to transfer the mortgage, why can't others? So would you have to show that you're still approvable?
I guess it gets to the point to where if you didn't have to sell, then you need to stay put. But if you had to sell, then this is something that would be of concern.
Are we only
do you go across state lines with all of this? I mean, you know what I mean?
Yeah. Are you only going to allow, if you're not going to make people go through the approval process again, okay, to transfer the loan, are you only going to allow people to do it to take advantage of their low interest rate they already have? Because they know if you're not doing that, they know then, that person just can't get approved for a loan now, so they're lower risk.
Right.
Why else would they want to transfer their 3% loan to get it when rates are at 2%?
Right.
But are you going to sell? But are they not going to be allowed to do it just because? Is that fair?
No, that's a good question. That's a very good question.
So,
I mean, it goes down to what I feel is leave it at status quo. Just don't mess with it.
It's not that broken.
I mean, it's. I think it's kind of like, I don't know. There might be people that might disagree with me, and that's okay. But it's kind of like, at my age, why get married? If it's not broke, don't try to fix it. Are there tax benefits to getting married? Yes. Or there's benefits to it. Don't get me wrong, but just like what we're talking about, there might be benefits to it, but it's not freaking broke. Just leave it alone. Leave it alone.
But a lot of people, because, and we don't know if this is even true or not when they say the home affordability. Yeah, there's some people that are in a situation where they can't get approved to buy a house, but there's a lot of people that do as well.
Right.
So when you say, if it's not broke, don't fix it, there's some people that do think it's broke, and that's why they're talking about it.
Well, because they can't afford to buy a home.
There's a million different things we can go into. But if they can't
afford to buy a home, then that's a high-risk situation.
Well,
and if it's a 50-year mortgage, maybe that might help, but...
Yeah, I think, that's the problem. People do think it's broken. That's why they want to come up with these ideas to, quote-unquote, to fix it. But when we joked about the car loans and stuff earlier, now this isn't, I don't know how many different tangents we want to go into, and everybody's different, you know what I mean?
Right.
We've done loans for people that are, I don't want to say everything we're talking about is a younger couple, but if this is geared towards your first-time home buyers, people getting the house the first time,
right?
That's generally what we're talking about with the affordability. There's some people we've done loans for, great, good credit, don't have a lot of debt, they save some money to put down. Even if you don't have to save a lot of money, there's no money down programs, there's 3%, now there's grants, so it's not like you need to save $100,000 to go buy a house, let that go away. But there's people that are responsible, and they get approved, and they close on a house. It happens every day.
Correct.
We've done a lot of them. It's not rare. there's also a ton of people that we see have that $1,100 truck payment on an 8-year loan, and this much debt and this much debt and these other things. And if it's two people, they might have decent jobs, they make okay money, but there's an $1,100 truck payment here and a $900 lease payment over here, whatever it is.
Right.
And then, but they only want their house payment to be $1,200, but that's more than their vehicles. Yeah. And then you're like, you should have, maybe wait to buy the car so after you buy the house or whatever, because getting approved for a car loan obviously isn't as cumbersome and difficult as a house.
Right.
So that could be the other issue. And, do you want to go into it's people like again, not everybody's the same, but we see the reason a lot of people can't get approved under the current debt
status
ratio structure,
right,
is because of the amount of debt they have that. I mean, it's not their fault. Vehicles got expensive. I get it, but the proportion of people that we see with what I think are outrageous,
the debt to income ratio.
Yeah. Mm-hmm. It's like it's almost like that's a bigger concern is the car than the house.
Well, it's like a status, I guess.
Yeah.
Well, it's like my dad always told me. I can remember, my first car, 1984 Ford Mustang. And it was used, right? Yeah. It was used. And it eventually the brakes locked on it and it blew up, caught on fire. But anyways, I absolutely loved it. I loved the car. And my dad was like, well, you need to save X, Y, and Z amount per month for, one, your gas, and two, for your maintenance on the vehicle.
Right.
And I went from that to, a lesser car. His point was, as long as it gets you to point A to point B, you don't need an expensive car.
No. Yeah.
And I get that, and we just talked about it. I needed a vehicle that suit my needs and so forth, and I understand.
But you're also
completely.
Not 22 or 23.
Correct, and I spend. Anyways, it's not about me right now. But
no, I know, but again, I don't. Not trying to get on a soapbox about.
You know what I'm talking about, though. The realization for some people. Well, I can afford a $1,200 truck payment, but because of you having that $1,200,
you can't have your house
you
payment.
can't have a house.
Right.
That's the point I'm trying to make.
Right. Phone's ring.
That was Scott.
That's the car dealership calling and yelling at us.
If we were live, I could understand that.
That'd be funny. No, like I said, not to make it a house industry versus the auto industry or whatever.
Right.
But it's just that, again, there's a lot of the reasoning behind not getting approved is because of that total. That's the only reason they want to go to a 50-year loan is to lower the payment a few $100
and the debt to income ratio.
Which will help you fit that debt ratio down a little bit to what can be approved. It's just moving the needle. You're not changing you're changing the payments a little bit, but you're just moving
like
the
I
needle.
said earlier, for some people, $200 is a lot of money per month.
Yeah.
That's $2,400 a year.
Mm-hmm.
That's sometimes it could be their health insurance per month, or it could be their groceries, or it could who knows? It's for some. For a lot of people, that's a lot of money.
Yeah.
For me, the way that I look at it,
to me, what I don't like is that they're spewing these ideas out like, here's the easy fix. Let's just stretch the loan out longer. Like that's the answer to everything.
Right.
And while there may be some logic to it, just like we said, if houses do keep appreciating, if things do go up, does it really matter if it's 40, 50, or 60 years? The balance won't be that much different in 5 years anyway on what you're paying.
Right.
It's just that you want to take advantage of they keep going. You want to take advantage of the house appreciation.
Do we need to pause? Do you need to answer that?
Nah.
Okay.
I don't know this.
Scott's a busy man.
Yeah. So, I just think that it's just a Band-Aid, in my opinion, to be a Band-Aid. Let's make a 50-year loan and, 20,000 more people in the country bought a house.
So you think that because the debt to income ratio is going to change, so is that going to change what credit score value is? No. Didn't Fannie Mae and change the credit score recently?
Well, here's the thing. Yeah, the thing is with the debt ratio really wouldn't change. The qualifying ratios wouldn't change. Your payments do. Like they're fitting the square peg in the round hole. Let's say you can only be approved at 50% now, and you're at 53. hey, but if we take this payment from 30 years to 50, we take your 53% debt ratio, now you're at 49, now you're good.
I gotcha.
You know what I mean? So we're still going to keep the debt ratio at 50%. We're just making the loan longer.
So I get that, but does that raise the risk of the people that were
to me, what it
obtaining
does,
the loan?
I think what the risk would have to be priced in is it's a longer term. Like the interest
And what
rate.
about the interest rate for that?
Yeah, an interest rate on a 30-year is longer than a 15. So a good question is, there's people out there that said, okay, when we look at how the 50-year would be priced, because, hey, if it takes longer to get your money back, it's a riskier loan.
Right.
They're again, the experts, but when they look at the difference between a 15 and a 20 and a 30 and then extrapolate that out to what would the risk need to be for a 50-year, they're saying it's going to be at least 0.5% to a full % higher than a 30-year. So now that savings of $200 a month might only be 160,
right,
150 because your rate's higher. If you can get 6.5 on a 30, maybe you're going to get 7.25 on a 50. Picture that. Hey, what's your rates on a 50-year today?
Yeah,
7.5%, 8%.
Yeah, I mean, but
it just sounds funny. But
well, I mean, why aren't we rewarding those that can pay off their loans in 10 years?
They do. They get a lower rate.
Well, they get a lower rate, but I mean, do you know what I'm saying?
Yeah.
I mean, it's just I get it. Affordable housing is very hard. It really is,
But to me,
I have a lot of first-time homeowners, but there are a lot of programs out there too that you have helped me with on some of my buyers, and that money that's out there, that they're getting a great rate and a awesome home, and they didn't have to put a whole lot of their hard-earned cash down, and they had no debt, but they just didn't have enough money to put down.
Yeah, and there's other things. There's so many different variables going to like affordable housing and bringing prices down and whatever.
Right.
And at the end of the day, it's a double-edged sword. People don't want to bring the cost of housing down too much because people don't want their house prices to go. If all these if you could suddenly snap your fingers and figure out a way to build a bunch of single-family homes a lot cheaper all of a sudden, well, that's not good for all the other houses because now they're going to go down in value.
Right.
So
the depreciation.
People don't really want that. They just want to qualify people more. You know what I mean? Like, is there a way to make lumber cheaper? Is there a way to make all the trades cheaper? Is there a way to make all this stuff cheaper?
The fact that it's also, a lot of people turn to renting because they can't afford to buy a home.
Right.
And, and in turn, if that's the answer for some people that are wanting to live in a house and not in an apartment, that they have to rent the house, that affects you and I. I mean, it really does. But, there's a lot of experts that say, well, sometimes renting is better.
Yeah.
I don't know if I agree with that. But.
Yeah, well, like anything, you could have a situation and give reasons why renting for 2 years is better than buying, and there's reasons that you could take that exact same scenario, flip it around, and argue it otherwise.
Correct.
There's going to be someone that's right, someone's wrong, and there's who knows.
I don't know, Scott. I don't know about this.
I just don't think they'll call it the portalette mortgage when it does.
I think the porta potty
mortgage.
Because I think
like
it's shit.
Logistically, I'll go to record. I never see that happening as long as I'm around. But
you get that? I thought that was pretty funny, Scott.
If it does, I will nominate Porta Potty Mortgage as the official name of that product.
God. I cracked myself up. I thought that was pretty funny. He doesn't think that's funny.
That's where all the ideas will end up, though. But that will be in the porta potty because it's.
What do you think? What is your opinion? What do you think?
That'll go nowhere. That idea will go nowhere.
But what do you feel would be in a perfect world? I mean, in a perfect world, affordable housing would exist. But what do you think an answer would be for affordable housing?
I think a lot of it has to do also with expectations that people have. I think people, again, I keep saying like everybody's the same. There's a lot of people out there that still have like the mentality that a house payment, the mortgage, I've seen it has to be $1,500 less because that's what they thought rent was somewhere else or what.
Right.
It can be $1,500 less, but they want to go buy a $400,000 house.
Right.
It's like, okay, well that payment's gonna be with taxes. You're like at $3,000 or $20,000, whatever it is. You're way off.
Right.
So I think a lot of it's just, but they don't, again, not them all, not everybody.
Right.
But they don't have a problem going out and walking on the car lot and driving away that an hour later
With the $1,100, yeah.
So it's like
that, or if they're buying, in their budget of a $200,000 house or lower, they're expecting a perfect home, and that's not the case either.
Right.
At price points, there's going to be problems.
Maybe your first home doesn't need to be the brand new build.
Right.
Maybe you do build up the sweat equity and do your repairs, and not that everybody's going to be a home improvement person, but yeah, maybe that first home is a little bit smaller than you wanted. Maybe you do need to do some painting and carpeting and do some sweat and clean up the outside. And maybe 5 years later, it's worth X, and you can sell it and take that money and put down. And so there's a lot of ideas. Yes, magically making the houses cheaper sounds great, but just because you're stretching the debt longer doesn't mean. I'm not saying it doesn't work for some people. Mm-hmm. It's not an instant cure-all of what's going on.
Right. Well, you know what, Scott.
The phone's not ringing.
We're trying to solve the world's problems, but I don't think that's going to happen today.
We're going nowhere fast.
I know, but I appreciate this conversation with you. I hope that answers some of, questions out there from some of my, buyers and sellers, as well as your clients too. And it's just, I don't know, we're going to have to come back on this conversation if it does pass and it does.
I don't. Yeah. You can maybe hold your breath a little on the fit, just because logistically that can happen.
I think we'll talk about the 50-year loan. I think that might be another.
To me, that wouldn't be hard to implement if people wanted to do it. Your porta potty mortgage. There's not a spreadsheet big enough to handle all the scenarios. There's just not.
I like the name. I'm not going to lie. I think it's because we all know how I feel about it. Because anyways. All right, guys. Till next time, Scott Simpson with Interest Mortgage, Claudine Andrews. Reach out, listen, share, all of the above. Till next time.